meant.
All right, now we want to switch gears and have that conversation about the bond market. We want to understand what is happening in that space. Why are investors shying away from investing in government bonds? Now, to help me with this conversation, Ronny Chokaa is joining me virtually. He's a researcher from Genghis Capital. Ronny, good afternoon.
Good afternoon to you, Jimmy.
All right, Ronny, I want you to paint a picture for us in terms of what is happening in our bond market. What are you currently seeing?
So in the current bond market space, what you're witnessing is that in the secondary market, to be precise, we are witnessing declined activity. And this is largely on the back of rising yields. You know, with the rising interest rate environment, it's making it quite difficult for bondholders to absorb that mark-to-market loss. And as such, they prefer now holding their bonds to maturity, at least the majority, holding bonds to maturity so that at least to avoid that mark-to-market losses.
All right, Ronny, when you look, and I'm sure you engage with a lot of investors on a regular, now I want you to help me understand what is their sentiment currently, particularly about the Kenya bond market?
So a number of concerns are emerging, particularly regarding duration risk. You realize that there are concerns about the liquidity crunch in the government, and that the government may actually not be able to service their bond obligations when they fall due. And that is actually a major concern among investors in Kenya in particular. And from our viewpoint, we actually recommend to investors to kind of balance the duration risk. And this is how, by a strategy of riding the yield curve, where at least you don't play so much on the longer end spectrum, but on the shorter end of the yield curve.
All right, I want you to do a comparison for us. When you look at government bonds, when you look at corporate bonds, how are they trading?
So intuitively, you would expect corporate bonds to trade at a higher yield compared to government securities because of the risk premium that is actually added onto corporate bonds. So currently, there has been minimal trading activity on corporate bonds, but on even on the minimal that has taken place, you notice the average spread between the government securities and corporate bonds of similar tenors is roughly about 1.3% on average. So given the current environment where yields are rising, and this is not just a Kenyan phenomenon, yields are rising across the global markets. And what we realize is that for corporate bonds, especially those without variable rate coupon rates, you'll realize that most of them stand to erode a huge chunk of their value because of their rising yields.
All right, Ronny, and I know you touched on this earlier on, the issue of interest rates. Now, we've seen interest rates rising, not only in Kenya, but globally. This is something that is currently going on. In terms of the effect that is going to have on the bond market particularly, what are we looking at in the next, let's say, in the next year or in the next 2 years?
All right. With the rising yields, there are a number of implications. Firstly, if you look at the broader, in the context of the general economy, macroeconomy, you find that with the rising interest rates, you find that even in the advanced economies, in particular the US, for example, yields have also been rising to a large extent. So you find that US securities are becoming more attractive compared to government securities in emerging and frontier economies. And as such, it's really no wonder when we see capital flights from frontier economies and emerging markets into developed economies. So that's one implication of the rising interest rates we are currently experiencing. Bringing it closer home, with the rising cost of, with the rising yields in particular, we expect that the asset valuations to be thoroughly impacted, particularly bond valuations. We anticipate that with the rising yields, of course, there's an inverse relationship between interest rates and bond prices. And as such, with higher yields, automatically bond prices will be thoroughly impacted. And we are seeing this currently with the banking sector results and even insurance companies who are kind of concentrated in government securities.
All right, Ronny, I can see an alert on our screens telling us that we are pressed for time. Just before I let you go, so in terms of going into the future, where do you see investors putting their money?
So going forward in the Kenyan space, we've been witnessing a kind of an investor apathy, whereby in the equities space, investors are kind of shy of investing because of course, how the NSE has been performing. And coming over to the bond space, we expect new investors to ride on the yield curve. You find that the returns on short-term papers are becoming particularly attractive. You are aware, of course, that the 91-day T-bill rates crossed the 10% mark. So this presents a very low reinvestment risk for investors, and it's quite a lucrative time for new investors. For those who are holding onto bond securities presently, I think the incentive is to hold their papers to maturity to avoid taking in or absorbing that mark-to-market losses precipitated by rising yields.
All right, Ronny, thank you so much for making time for us and for sharing your insights. Now, we want to take a quick break right here on Business Today. I will be back with more.